Choice of entity, taxation of startup losses, problem 1. Pear, an individual, plans to start a small business which will operate as a corporation. In year 0, she expects the corporation to generate an ordinary loss of $100,000. Subsequently, she expects the corporation to be profitable and projects ordinary profit of $150,000 in year 1 and $250,000 in year 2. Pear's personal marginal tax rate on ordinary income is 37%. Assuming a corporate tax rate of 21% and a 10% discount rate, calculate the present value of expected tax costs on the business earnings for the first 3 years of operations if the business does and does not make an S corporation election. This is an excellent question. It's looking at the differences in tax when you have an S corporation election versus a non-S corporation election in place, and it also deals with the present value of expected tax costs. So normally when we look at taxes, we don't consider present value, but you really do need to consider present value for the timing aspect. So we need to go through, look at this information, and we need to determine calculate the present value of the expected tax costs on the business earnings for the first 3 years of operations if the business does and does not make an S corporation election. What I'm going to do is I'm going to draw a line down the middle, draw a line right down the middle, and on the left side we're going to have does make an S corporation election, so does make S corp election. That's going to be on the left side. And on the right side, does not make an S corporation election. So does not make S corporation election. And again, remember what's going on here. We have a corporation, and under the law, for state purposes, a corporation is a corporation. But for federal tax purposes, there's a difference between C corporation, S corporations. C corporations are going to be double taxed. S corporations are going to be flow-through entities. And the S corporation, the flow-through entity, you can treat it similar in this case as a partnership. Of course, we know there's differences between partnerships, entities, taxes, partnerships, and S corporations, but the idea here will be the same when you're talking about the taxation of startup losses. Very similar when you're comparing against C corporation. So if we make an S corporation election, we're going to be an S corporation. If we do not make an S corporation election, we're going to be a C corporation. So S corporation on the left, C corporation on right. And again, S corporation, you can kind of consider it as well as a partnership. So if I ask you about partnership, it'd be very similar in terms of this problem information given. But if I change around the facts, S corporation versus partnership could change. Okay, remember we have an individual plans to start a small business, and like most businesses in the first year, so it's over a 3-year period, and what we're saying is the first year is year 1, the second year is the first year is year 0, the second year is year 1, and the third year is year 2 based on the information. So year 0, the company's expecting an ordinary loss of $100,000. Now, we don't have a crystal ball. We can't look into the future, but this is a pretty reasonable assumption. Most businesses, they generate losses the first year, and then if they continue going on, which most businesses do not, they actually do not continue going on, but if they do, they start generating profit. And the idea is that if it doesn't generate profit, that's why it does not continue in the future, because if it just keeps making loss, most business owners decide just to wind up the operations. So they're expecting in year 1, which is the second year, $150,000 of profit, and then $250,000 of profit in year 2. $250,000 of profit in year 2. So year 0, $100,000 loss, $150,000 of profit in year 1, and $250,000 of profit in year 2. Those are going to be very important. So let's go through and let's first calculate the present value of tax costs if we make an S corporation election. And the idea is that we're going to compare and contrast the two at the end. So let's just start with the S corporation, go through and calculate those things. So if we look at year 0, now year 0 is the current year taxes. Year 0, we have S corporation, and there's a $100,000 ordinary loss. And S corporation, everything flows through to the owner. And this is all operating income. It's an ordinary loss, as we're saying. There's no capital gains, capital losses, special characterization gains or losses. So everything is going to be taxed at ordinary income rate of 30%. So year 0, we have a loss of $100,000. And if we multiply that by 37%, which carries over. Now, we're going to assume that all losses in this problem are not subject to the excess business loss limitation rules and whatnot. So because it's an S corporation and it flows through to the owner, which you're able to flow through losses to the owner subject to limitations, as I just said, assume it does, one of the limitations does not apply, that $100,000 loss, put parentheses around show loss, equals a $37,000 tax savings in that year. Okay, so $37,000 in year 0. Now, we don't have to present value that because, or I should say, if we present value it, it's just a factor of 1 because it's in the current year. Now, let's go and look at year 1. So, year 1, we're told we have profit, and I'll put pi for profit. That's the sign for profit, $150,000. $150,000. And we multiply that by our tax rate, 37%. We're going to get $55,500 of positive tax owed. So I'm not putting this in parentheses here because it's a positive number. That's the amount of actual tax that we owe. So this is our tax costs, and we're looking over the 3 years. Now, I'm not putting it in this item yet because we have to present value this. We have to present value this. Okay, so we're going to take the $55,500 of tax costs, but we have to present value that considering the effect in today's dollars. We're looking in today's dollars, in year zero dollars. So we're going to present value that using a 10% discount rate. What we're going to do is we're going to take $55,500 and we are going to multiply that by the present value factor, which the way we get the present value factor using a 10% discount rate, we're going to take 1 over 1 plus 10%, or 0.10, which that's going to equal 1 over 1.10. And if we do that calculation, we're going to get, and rounding it to, assume we round to 3 decimal places for this, 0.909. 0.909 if we assume that round. So the present value factor is 0.909. So if we take 55,500 times 0.909, that number equals $50,450. So that is the present value tax costs for year 1. So we're going to go ahead and put that number in there, $50,450. Now we're going to do year 2. So that was year 0. We did that. We got the tax loss and the tax savings. That was year 1. Now we're going to do year 2. And we do a similar approach like year 1 because we have a profit of $250,000. And we're going to multiply that by 37%. We get $92,500. $92,500. So now we have to present value that $92,500. So $92,500 times the present value factor. The way we get the present value factor, what we're going to do is we're going to take 1 over 1 plus 10%, the same 10% discount rate, and we're going to multiply that by 1 over 1 plus 10%. So you basically are squaring that 0.909 number. So you're taking 0.909 times 0.909. That's basically what we're doing. And when you get that factor, what you're going to get is 0.826. So that equals 0.826. So again, rounding to 3 decimal places. So 0.826, if we take 92,500 times 0.826, we get $76,405. So $76,405. Now we've got our total tax cost for all 3 years. We just need to sum up the numbers. So year 0 is $37,000 of savings, and then year 1 we have $50,450 of tax costs, and then $76,405 is tax costs in year 2. When we do all 3 of these numbers, which we start with a negative plus a positive plus a positive, we're going to get a total amount of $89,855 of tax costs when you do the present value. That's the present value amount. So that is if we do make the S election. Now we're going to go over and assume it's a C corporation not making the S election. And notice that nothing in the problem tells us we're going to make distributions. So that's going to be something important as well. Now, if a C corporation, there's double taxation, but if there's no distributions that are made, you don't have to worry about the second level of taxation. Now, there is something called the accumulated earnings tax. I talk about that in another problem. But if we're able to avoid that, then you have one level of tax. And if that's lower than our 37% rate, you're going to see, and we're going to see it in a second, that the there's actually going to be tax savings because you're being taxed at a lower rate, especially considered time value of money. And you might not be able to get that benefit of the loss early on, or time value of money you can, I should say, and it's worth $37,000 today when we're doing the S corporation election. But if we had that loss in the future, it wouldn't be worth as much if you carry it forward like you're going to have to do with a C corporation. All that stuff I'm going to explain again, just giving you a summary. Now let's go ahead and start. So we're a C corporation. In year zero, we have a loss of $100,000. So thinking about the tax costs, what does that do in year zero? It does nothing. And the reason why it does nothing is because in a C corporation, you can't get a tax refund or any benefit from a loss. You can carry it over to the next year or carry it back depending on the rules. Here, we're in year zero, so you can't carry it back. You're in the first year of the business. You can't carry it. There is no possibility to carry back. You can't do that. So even if you're allowed to carry back depending on the year, we don't. We carry forward if we're a C corporation. So the idea is this $100,000 loss, we're going to carry it forward to the next years, and then we'll offset any income that comes along. So we go to year one. So that's year zero, no effect, no tax cost, no tax savings. So year one, in year one we have profit, again, pi is the sign, of $150,000, but we're allowed to carry over this $100,000 loss. So we subtract away the loss from year one. We carried that over, and we get $50,000 of profit. So we need to multiply that $50,000 of profit times our tax rate. Since we're a corporation, our tax rate is 21%, as we're told in the problem. It's a corporate tax rate of 21%, right, on C corporations like we have here. So $50,000 times 21%, that's going to be $10,500. So now we take $10,500 and we take that times the present value factor. The present value factor we already calculated, same as the present value calculation we did in year one for the S corporation election. It's at 0.909. The way we got that was taking 1 over 1 plus 10%, which equals 0.909, rounding to 3 decimal places. So we're going to take $10,500 of tax costs times 0.909, and we're going to get $9,545 of tax costs in year one. So we just did that, boom. So now we go year two, and we used all of our loss, all of our carryover loss. We've already used it. So year two, we're told we have a $250,000 profit in year two. So there's no loss to offset. So all of that is profit that's subject to a 21% tax rate. That's going to equal $52,500. We're going to multiply that by our present value factor, which we've already calculated, same as the S corporation present value factor of 0.826, same way we got it, just squaring the 1 over 1 plus 10% and squaring that number, right? 0.909 times 0.909 gives us 0.826 rounded to 3 decimal places. So times 0.826, that's going to equal $43,365. So we got our costs in year zero. It's $0 because, again, C corporations do not get the benefit of losses. You have to carry it back or carry it forward. Then, or you don't get the benefit of it in that respective year, in the year it happens. You have to carry it back or carry it forward. Then year one, we have a tax cost of $9,545. And then year two, we have a tax cost of $43,365. If we add those two numbers together, we're going to get $52,910, and that is our present value tax cost of being a C corporation. That is the present value tax cost of being a C corporation. So notice, if we are an S corporation, our tax cost is $89,855. If we are not an S corporation, we're a C corporation, we're $52,910. So you're saying, okay, well, it's better to be a C corporation. Well, yes, given these facts and circumstances. There's nothing in here, though, about the second level of tax on distributions. Of course, we know that at some point, the owner is likely going to have to take out distributions. Now, there are ways to avoid the accumulated earnings tax. I talk about the accumulated earnings tax in other videos, but there are ways to avoid it. But usually, if a business owner is the sole owner, they want to get money out of the business. And when they take money out, you're going to have another level of tax. Could be on the preferential rate, could be on their ordinary income high rate, depending on their the dividends and the brackets and everything. Changes based on that. Also changes based on the year in terms of how much is taxed, and that would make it much more costly in terms of taxes. But just looking at this information, it is better to be a C corporation. Now, one thing to take note of with present values, that $37,000 of tax loss of being an S corporation, that's actually a huge benefit when you consider present value, because if we carry over that $100,000 loss to year one, it gives us a benefit of a tax benefit, but it's not the same as in current dollar value as the $37,000 was, because we didn't even have to present value that. So keep that in mind. If you're a C corporation, you have a loss and you have to carry that over to several years in the future because you keep generating loss. The idea is that time value of money is not going to be the same as if you're an S corporation, you carry that over. So this is meant to show you present value and how big a difference it makes. If we put in some distributions in here, it could also make a big difference, but I at least want to show you being a C corporation at times can be it can save you money. And yes, generally we eliminate C corporation when we consider C corporation versus S corporation versus LLC, because again, the two levels of tax and other reasons as well, but the main thing being the two levels of tax, which ultimately cost more in taxes usually than a S corporation or LLC. But depending on the facts and circumstances, a C corporation like you see here might actually work out to make sense from a time value of money standpoint and from another standpoint. And another thing to consider is in year 0, 1, and 2, we have these issues, and maybe we don't take our first distribution till year 10. Well, okay, but year 10, if you're considering as year 0, you have to present value that tax cost of that second level of tax in year 10, so it's looking even more favorable to be a C corporation. Now, this all can change depending on what the C corporation rate is. Here it's 21% versus 37% when it flows through as an S corporation. If we increase the corporate tax rate to 28, 35, 40%, whatever it is, it obviously becomes not as much of a benefit. So keep that in mind as well.